I'm really, when I look at it, I'm 90 odd percent sold. Why?
Yeah.
Because the chart is outperforming Bitcoin and ETH. I mean, there's no philosophy behind it. It's like, I like Solana, love what they're doing, and it's proving it on the chart. If it doesn't prove it on the chart, it hasn't got network effects. Because you and I have talked about this. I built that Metcalfe's law thesis around this. And basically, I found that tokens are actually priced rightly. Almost everything prices pretty much according to the number of active users and the total value transacted. So in which case, price is good.
Raoul Pal, a renowned crypto expert, recently discussed airdrops, the token economy, and the future of crypto adoption with fellow enthusiast Burniske. Pal believes that the market will eventually move toward an ICO model in which 70% of tokens are released early, and that fully diluted valuations will become less necessary. However, he worries that this strategy may result in misaligned incentives. Pal noted that Bitcoin has risen 150% yearly since 2011 and that early-stage tokens like Ethereum have grown even more. High-fit and low-flow incentivize teams to seek for growth. He noted that capital efficiency is challenging owing to the ongoing production of wealth and the inflow of new money, but he wanted to examine tactics like the Su-Trip, which simplifies complexity and advances technology. Fred argues the key to success is integrating crypto into Web 2 so it's accessible to more people. Watch interview footage to learn more about Raoul Pal's talk with Burniske. Like this video, subscribe, and enable post alerts for more stuff. Enjoy the video.
How I started framing this, I always try and simplify, and I've got it down to this. This is the underlying, it's the new underlying infrastructure for the internet, as we've talked about. And people get confused. When I go around marketing our Thunder funds, people get confused still but there's this Bitcoin narrative, this narrative, that narrative. And I'm like, stop. These are all decentralized businesses that sell block space. And they have different qualities to their block space or a different narrative on what makes their block spaces effective. And that is, once people see that these are essentially decentralized businesses that operate and sell block space, people start to understand. And what's unique about this infrastructure layer, it's the first infrastructure layer in history that we can all participate in because of the behavioral incentives of a token system versus equity. And so when I look at it, I just look at the growth of the space, and it grows at 100 and something % a year, which is twice the speed of the internet, because obviously it's built on internet rails, so it should go quickly. And I just extrapolate that trend out, and I look at it, and it's like, well, it's a $2.5 trillion space today. If we carry on, by 2032, it's 100 trillion. I'm like, that's the largest accumulation of wealth in all human history in the shortest period of time. Even if I'm wrong by 50%, because I'm a total moron, it's the same as 100 years of value accrual of the S&P 500 in 8 years.
Right.
It's bananas. It's because we can own this adoption layer, and all of these businesses selling block space, that's all it's about. Best thing is just try and capture that growth first. If you're going to do anything in the space, stop trying to focus on the one thing. Just capture 2.5 trillion to 100 trillion. You'll be absolutely fine. Explain this to people a lot. I don't care what people's philosophies are. That's not how you make money. What you make money on is owning the best performing asset on a risk adjusted basis. So what I tend to find is that the mid to upper part of the curve, which is networks gaining adoption, do best. ETH last cycle, Solana this cycle, and whoever it's going to be this cycle, whether it's Sui or whether it's Near or whatever it is, I don't know. We will see that, right? That is the easiest opportunity we get in this space to generate wealth. So firstly, focus on that. That's the do not fuck this up thesis. If we're going from 2.5 trillion to 100 trillion, do that and you'll make a lot of money.
Yeah.
And so then I just filter out as many people as possible. I really only get signal from a few people that I'll ever listen to. If you tweet something, I'll always read what you tweet because I think you'll have a high signal to noise ratio. Most people are high noise to signal ratio. And so I'll observe it for sentiment and any nuggets, but I try and filter out as much as possible and just stick with, unless something shows that network adoption is slowing, I'm right. So just capture that.
Right.
Then I don't FOMO in the rest. I just don't do it. So I don't spread. I did that last cycle. I tried to spread amongst this narrative, that narrative. And what I do now is really simple. It's idiot proof. I just put the chart against Solana. If something looks like it's a sustained trend against Solana, I'll allocate some capital to it. And again, only about 10% of my portfolio will I do in that kind of stuff, but you can make a lot of money in those. And so, that's what got me into WIF and Bonk, because they were outperforming Solana. So I'm like, okay, I can do that. And now, if anybody shills me something, I just say, well, show me the chart outperforming Solana and I'll take a look.
Right.
That discipline makes it ultra easy for me, because I think because of this everything code liquidity cycle, everything is correlated, every asset in the world, which makes it and it's all driven by the same debt refi cycle, which makes it, I think, the easiest macro risk-taking environment of all time. Because the central banks have also taken the left tail out by saying we can't let collateral fall too far, so we will debase currency. Holy shit, if this is the case, then we have the simplest, easiest risk-taking opportunity of all time. So hyper-concentrate, I think, is the way. Now, there are people who can do the tail part, hyper-concentrate and get it right.
Considering an ICO model with earlier token distribution, Raoul Pal underlines the importance of increasing Bitcoin accessibility and integrating it with the Web 2 environment as the cryptocurrency market shifts toward less FIV. Despite their popularity in retail, airdrops encourage users to dump tokens quickly, which causes salary disparities and market instability because they make less money each month than U.S. residents. For example, a Filipino may sell a token for $10 in enough communities. Airdrops were meant to reward early investors and give ownership to those without funds, but they've become reliable and drawn investors. Well-meaning business owners struggle to identify farms that take advantage of earnest actors, resulting in overpromising and dissatisfaction. Due to the industrialized airdrop farming complex, fewer tokens are going to actual participants. Rarity early airdrops like Uniswap and Goo were successful, but over-farming has weakened current ones. The 2017 initial coin offering ICO strategy, which saw 80% of the supply go through on day one, balanced the market. Some tokens and apps have been destroyed by airdrops, which have turned into teen angst. Intimidating actors are drawn to launches with high valuations and reliable airdrops. Returns the interview.
Right. Yeah, this is one of the tragedies that I see in the way in which social media, even though it propels crypto because it's intertwined with crypto, also it's a medium that's set up to mislead from the core of what crypto is. So it's like, I'm a little more boomer than you on a personal basis. Vast majority is BTC Sol. And then of course I run a venture firm, right? And so we do make venture investments and, those.
Yeah. So you're actually set up the same way as me, because you basically have a core portfolio of quality assets. The rest of your attention is focused on the tail, which is
exactly because the core portfolio doesn't need your attention, right? And I think that's one of the core things I think about for crypto at large is it's a way to better distribute capital, because it's like for capitalism to work, everyone needs to become a capitalist in the sense that they need to manage capital of some kind. And I do think that, blockchains, it used to be you just had the major leagues of, call it liquidity. Now blockchains allow for single A, double A, triple A into the major leagues. And so there's a lot earlier distribution. There's a lot more granularity on what you can be a specialist in and the types of capital you want to focus on and do well off of. But you still invest in the indices, and the indices are BTC, ETH, and Sol, right? And you don't have to do much work at all. Sure, you can slosh around a bit through cycles to, juice the multiplication. But, going back to crypto Twitter itself and the way that social media and TikTok and Instagram and whatever is misaligned is it's like those mediums are so fixated on virality and the news thing and who's got edge and who can stand out in that way. And so it sucks 90% of the attention into those things, and 10% of the attention on the basics of BTC and Sol. Whereas in reality, the portfolio distribution is the opposite.
Well, that's telling us the arbitrage is there, right? It's like attention. The fleeting attention is not quality attention. The quality attention is the attention that accrues to the activity on the main layer ones.
Yeah.
So it's kind of telling us that the more attention goes to memes or whatever the latest thing, airdrops or whatever, actually you're more likely to garner attention further, on the infrastructure layer. And maybe there's something within that. I'm starting to believe there's something a lot bigger in attention that we don't yet understand in terms of how we can use this as a major metric. Because I think what you're saying is something important as well, is when all the attention's on short term, you generally make more money on the long term. And if everybody's focused on Bitcoin, you're going to make more money in memes, which is why memes crushed it in the beginning of the cycle, because everybody was focused on Bitcoin, because that's what you do at the beginning of the cycle.
U.S. Treasury Secretary Janet Yellen has warned that the country's enormous $34 trillion debt load is driving away foreign exchange reserves and stoking collapse concerns. Bitcoin and other cryptocurrencies have surged over the past year despite a warning from the Federal Reserve, aided by bettors who believe former President Donald Trump will win the White House again. She concerns that U.S. financial penalties will reduce the currency's global impact. Yellen advised legislators that nations want to avoid using the dollar in international transactions as the U.S. imposes more sanctions. Larry Finking, BlackRock's CEO, is likewise concerned about the national debt, believing that future generations would suffer the brunt of the U.S. excessive spending. Advocates boosting the economy and reducing deficit impacts. Additionally, Bank of America economists noted that the U.S. debt load is growing by $1 trillion every 100 days, driving up Bitcoin prices. As investors seek alternatives to the dollar, debt debasement trades are nearing all-time highs. Do you agree with this interview and think Bitcoin and AI can merge? What else do you see happening? Leave a comment below. Thanks for viewing, subscribe, and like this video.